There's a bit of a dichotomy in terms of the performance. So Australia's lagged. The rest of the world generally we're up still, positive by about 0.4% on the broad cap, up higher in the smalls, which again is showing a bit of a divergence over where the valuation opportunity is and where people are willing to invest. So finding opportunities in small caps and being happy to take on the higher risk of some of those assets. But those markets lagged, offshore markets, and they were driven by tensions around tariffs being proposed at the start of the month, those tensions being wiped out, and talks between China and the US seemingly quite constructive. And so overall the market in the US was up about 3 or 4% depending on which measure you look at. So, and again, a lot of that's still driven by fundamentals. So earnings are relatively robust. Apart from the big 7 businesses which have actually had valuation pullbacks, so the prices have eased compared with other parts of the market, but they're very much driven by fundamentals. The earnings growth is still being delivered in the order of 15% of those in those businesses. There's some really good data on that. So there were earnings reports that came out from most of the large cap tech companies in the US, and they're still reporting quite strong earnings. I think that the question mark now in markets is there's speculation around bubbles, and I think because valuations are so high, it's like a rubber band, right? If you pull on it too far, it'll snap. But if the fundamentals are there, that means that the valuations can be supported. Now, you can never pick the top of a market, and things are toppy, but if they're supported with fundamentals, then that should continue to support confidence in the pricing of those securities in market. Nvidia pushed through a $5 trillion market cap, so the first business to do so. It's massive numbers. That is being supported by real money being put into their products. You know, people are buying their products. There's clearly a little bit of speculation in terms of what the growth of that product and the demand of that product will be. And this is where the concern's starting to come in, is people are starting to dig a bit deeper as to how that's being funded, what sort of money needs to be put in, and what sort of revenue numbers you need to generate from these sorts of assets. And this is where the question is, I think, at the moment, is while the earnings and the outlook fundamentals are sound, they really do need significant growth from consumers. So people buying Microsoft Copilot licenses, and people paying for ChatGPT, and people looking at Gemini and paying for that as a service. So all of those positive catalysts from an AI perspective need to start to be realised commercially. Diversification is a key fundamental of the thought process of how we build portfolios. And there's different approaches in terms of how we consider different managers in portfolios as well. At the moment, we're looking at making some minor changes to portfolios to further diversification in the portfolios. So because valuations are relatively stretched across markets, we want to make sure that we've got a range of different levers that we've got within the portfolios to make sure that we're not concentrated or not having undue risks added in the portfolios. Currency was relatively flat in the month. It's a very short period of time, and with the divergence in rates, certainly from the US to Australia, we'll talk that specifically at the moment. The rate differential is starting to widen, and clearly with the inflation number here being higher than what was expected, that's pushed out the expectation of when an interest rate cut may come through here. Some are forecasting now not until 2026, mid-2026. And so that's starting to play into, I suppose, a bit more support for the Australian currency, that people are a bit more confident that rates here will stay a little bit higher, a bit different to what's in the US, and therefore that trade-off plays through into a slightly higher currency. You've also had stronger commodity demand coming through, and the prices are a little bit mixed at the moment, which is clearly a positive for the Australian export market and demand for the Aussie dollar as well. clearly with the Fed making a move to cut rates by 25 basis points, bond markets in the US were actually quite volatile. So even though the start point and the end point were not too different, so started about 4.3% on a 10-year bond yield, dropped to about 4.1 by the end of the month. It actually dropped below 4% in the month, and that was around the time of when the rate decision was coming through. So markets are expecting and moving for those rate changes, but you're starting to see a greater spread divergence between the longer dated securities, which is something we've been talking about, which is the market, I suppose, grappling with the tension of inflation and how confident they are that inflation is now under control, and the debt burden, the US debt burden in the US, which and perversely is probably related in some ways to the shutdown that they've recently had as well, which is trying to find budget or trying to find money to spend to be able to fund the employees of the federal government. And the longer term impacts of the spending profile of the US government, which is still in question, which clearly is what the 10-year or the bond markets are grappling with for how those sorts of assets should be priced. There's a couple of things that we're looking at. One we don't have a lot of exposure to, but it does create a lot of headlines at the moment, which is private credit. It has been a very fast-growing, fast-moving part of the market where there's been a lot of new funds, a lot of new products offered to investors, wholesale, retail investors. So most people would have seen headlines or seen products advertised that are offering pretty attractive interest rates or rates of return. And the regulator here is looking to make sure that people are really aware of the risks that they're taking if they're investing into those sorts of assets. So they've put some stop orders on a couple of products which were not disclosed appropriately in the market, which have been revised and brought back. They've looked to shut a few funds down where they've deemed that they just weren't viable products. And it's one that you need to be cautious with, because of the growth in the market and the growth in the opportunity set there, it starts to play into higher risk types of assets that, or higher risks in terms of the lending that they're doing, the types of assets that are being brought into those portfolios, how they're managed. So that's one that we're quite cautious on. We do have a very small exposure in that space, but we think it's with a very high quality manager, which has got the right experience, the right team and the right capabilities to manage what risks are in those assets. We won't see too many company announcements. There's no earnings expected to come through generally across the market. The banks may report their earnings as we get through this little period now. So you're not getting a great deal of information from companies until early next year. With rates coming down though, the expectation would be that companies are starting to see changes in consumer patterns. So you're starting to see a bit more confidence in consumers and them willing to go out and spend a bit more. We've seen rates cut down to probably more neutral levels, and there is still room to move from central bankers if they have to. So I suppose the outlook is still pretty optimistic. Companies are still performing well. Fundamentals are holding markets through. It's not without risks, but it's certainly one that we're relatively optimistic about what the outlook is.